Welcome back. This is SeeWing Yee from the Yee Real Estate Network. Today, I'm going to do a very deep dive into the anatomy of a real estate investment property. I'm going to go through all the numerical metrics, right? Which is very critical. A lot of us, whether you are a rookie investor or whether you are a experienced investor, the things I'm going to share with you, all the metrics, all the details of the numerical analysis, which is critical to for you to make a decision how to underwrite a property, how to analyze all the real estate metrics. Okay, and just bear with me. This is so critical. Once you learn this, you're going to be a much better real estate investor. You're going to be have a lot of confidence because you know how to underwrite your property. You have to look at all the quantitative factor, all the qualitative factors to go into making a confident, well-informed, intelligent decision to buy a particular property so you can grow your real estate portfolio over time so you can achieve your financial freedom goals and objectives. All right. So although I'm going to share with you a co-living property, it also doesn't matter whether this is a co-living property or not. It's just it's a slightly different metrics. That the kind of explanation that I'm gonna use is no different than analyzing any investment property. Single family home up to 4 units, residential investing. All right. So, but I'm gonna use my co-living rent by the room model as an example. All right. So with that in mind, let's dive deeper. This is the big picture. I'm going to share with you the new construction, purpose-built co-living rent by the room investment model. If you've been part of my network, if you've been part of my YouTube channel, you know I've been promoting this. It's an amazing real estate asset class. But if you want to learn more about it, uh, be part of our network, free member of our organization by putting your email into my website so you can become on my database or your newsletter so you can get your weekly newsletter into your email inbox to learn more about co-living property and other investments in other markets that we have, turnkey cash flow, new construction in the growth markets with property management, the whole, just hands-off investment, turnkey 100%. All right. So, but I'm just going to go over the co-living aspect, co-living properties, in which we have many markets. Our team is amazing. We've been doing it for a very, very long time. We know the market, we know the regulation, we know all the metrics, we know where to, build the co-living property for you, the whole 9 yards, right? We are expanding amazingly. We are the top class of quality co-living properties in the country, in my belief. All right, so this is a great new construction. I'm gonna use this example, although we have different models. I'm gonna use this particular model to go over the metrics. Okay, this is a single family home, 1,800 square foot, give or take, 7 bedrooms, seven private bathrooms, rent by the rooms, and you saw these metrics, right? So just keep that in mind. And again, this is the initial pro forma, but I'm going to show you another pro forma on this particular property. So meanwhile, just go ahead and digest this screenshot on your own at your leisure once you replay this video so you can dive deeper into how we come up with all these kind of metrics. Of course, we use Pass Split as a marketing tech platform to pre-screen our workforce tenants and they collect the rent. They do all the rent collection, rent screening, the background check of our member tenants that occupy each room. All right. So Pass Split, of course, we also going to use an 8% fee to hire our co-living property management, 8% monthly fee of the gross rent for our property management to do all the work for us, and also Pass Split another 8% of our gross rent. So, all right, and this is the metrics. I'm gonna go into deep dive how we're gonna come up with these metrics, and you're gonna blow your mind. You're gonna become a amazingly much better investor after you watch this video because I do not believe anybody else in the country, either now or in future, will truly go into details of what makes a rental property one of the most prudent and the most attractive real estate asset, any kind of asset class in the world, right? Better than any other asset class. So with that in mind, I'm gonna stop sharing this, and I'm gonna go into uh, this particular metrics right here. All right, so I'm going to go into my property tracker. I'm going to explain to you in a hopefully in a layman's term what some of these metrics means is so important. All right. So anyway, this particular property is 325,000. You put 20% down payment, right, which is 65,000 closing costs, all pretty simple input. And then your total out of pocket is around $74,000. That exclude the furniture package you have to purchase to furnish the rooms to accommodate each member tenants, right? So I'm not going to include that. I'm not going to include that in the down payment. So you can do a 20% down payment, and we have a builder. If we use our builder, we have an amazing interest rate, mortgage rate buy down of a amazing 5.5% 30-year fixed rate on a DSCR loan, debt service coverage ratio, no W-2 and no tax return documentation. Just the lender gonna underwrite the property itself. If the property itself qualify, then you can get the DSCR loan, and no one else in the country can offer this rate buy down 5.5%, where but the real investment rate is probably around 7.5%, either a full doc Fannie Mae lending guideline or other DSCR loans out there that does this kind of underwriting of this kind of property for lending purposes. So you consider yourself very lucky to able to run into our organization, our team, and our builder and our lender all in-house. One-stop shop will provide you tremendous amount of value, okay, to work with us. All right. So imagine that if by getting this rate buy down 5.5 instead of 7.5% or even 8% DSCR loan with other lenders to finance other property, on this kind of loan amount, on $260,000 loan amount, you're saving approximately around $500 monthly cash flow extra per month by having this low builder rate buy down of 5.5%. You see the value that we provide for you. Now, that's not the end. Now, the reason why this property qualify for underwriting for DSCR loan, which is typically 1% ratio, you're getting a 2.38 debt coverage ratio. A 1.0 debt coverage ratio qualify for the DSCR loan with a competitive um, uh, investment loan rate, but you're getting double the debt cover ratio that DSCR lender requires. So just to show you how much of a buffer we have because of the fact that we have a high cash flow property in this situation, right? Right? And the capitalization rate, 13%. Usually, the typical benchmark for capitalization rate is for a typical investment property, like a traditional long-term rental, is probably 4 or 5%. But we're getting 13%, which is triple the cap rate on a traditional rentals because look at our rent, which is astronomical, right? We rent $1,000 per room per month for each member tenant. So 7 tenants occupying a room, each room with a private bathroom, $7,000 monthly rent equals $84,000 of gross rent, which is huge amount of money, right? So co-living is amazing. It's amazing asset class. It's the fastest growing asset class in the country. For the foreseeable future, we are just the beginning of this tip of the iceberg, at beginning of this amazing trend, amazing asset class, right? So we minus all the applicable debt service. Your monthly mortgage is 1476, right? 30-year fix, minus vacancy factor, minus taxes, insurance. property management fee 8%, and past split fee another 8%, total of 1030 per month. And then maintenance, of course, you pay as landlord, as a host for the co-living property. You have to pay for the furnishing. You have to pay electricity, internet, garbage pickup, everything else, which is included in the estimation in this box right here, $700. Maintenance, typical routine maintenance, right? Which is property management will do for you the whole 9 yards. So this is the operating expense, then equal net operating income, then minus your mortgage payment, 1476, equals a monthly net cash flow in excess of $2,000 if all 7 rooms are fully occupied 100%. But so as a result, your cash on cash return at the end of the first year is 33%. How do derive at that? Look at this propertytracker.com, which you can get it for free, the software initially, although I pay a subscription. I've been paying subscription for this property tracker for the past 15 years. So cash on cash return is one metric which is very important. It just it describes how much of your down payment you recoup on a year-by-year basis. At the end of the first year, you recouping 1/3 of your down payment, which is amazing, isn't it? How this was calculated? You calculate by your annual net cash flow, right? Your monthly 2033, your annual is 24,400 annual net cash flow. This huge chunk of money divided by your down payment of 74,000 equals cash and cash return of 33%. So 2 more years approximately of similar monthly and annual cash flow at the end of the third year, 33 plus 33 plus 33 equals 99, 100%. So at the end of the third year, you can recoup all your money on the virtue of cash flow alone, net cash flow from your initial risk, from your initial down payment. Does that make sense so far? Okay. So this is a very, very simple explanation. You need to understand this numerical metric. It's very important. All right. So cap rate is kind of hard to understand. Cap rate is without any kind of leverage is your operating income divided by the purchase price. So your operating income, which is your rent, your annual rent minus vacancy. Operating income is 77,280 divided by the purchase price 325K equals your capitalization rate of 13%. This is the real rate return without any kind of leverage, without any kind of mortgage. 13% is very, very high on any type of rental property, especially a traditional renter can only give you like 4 or 5% cap rate, at the most. But this is a unique asset class, co-living, all right? It's up and coming, skyrocketing in growth. Now, another key metric you really need to understand is that's why rental property is a multi-dimensional asset class. Cash flow is just one component, right? There are like 6 profit centers. You have to calculate 6 profits, to see the real return of a rental property on a year-by-year basis, right? That's why the return on a rental property is so much higher than the returns of any other asset class. You're talking stocks, Bitcoin, or whatever, or crypto, or gold, whatever. Nothing beat income property, rental property. Okay, that's how sure I am. So the return on investment, that's so critical, right? So the explanation return on investment is right here. You see over here, return on investment is a total return as a percent of what you invested. We show you versions that include inflation-induced debt destruction, IIDD, and tax benefit. We have added some component on this software to add the debt destruction, inflation-induced, and tax benefit. Right? So this is just a tip of the iceberg. So return on investment is calculated by, it's right here, okay? Let me. So if return on investment at the end of the first year, right, which is 60%, isn't that huge? 60%. Now 60%, how do you derive at this number? So you just add you add the annual net cash flow right here. You add the principal pay down, which is 3502, right? You still get a little bit of principal pay down by the tenant. The tenant gonna pay down all your debt for you and your expenses. And then this component, a lot of people do not understand what I mean by inflation-induced debt destruction, another economic benefit. So the explanation is a trademark of Jason Hartman. Okay, I'm using permission to use with attribution. Okay, so as inflation happens, the real value of your loan balance go down. IIDD is a better metric. Okay, is projected inflation rate as multiplied by the total loan amount. Okay, we even incorporated the inflation rate, which is where is it? Where is the inflation rate? Oh, yeah, right here. See the government CPI inflation rate as of July 26. This software is real time. Propertytracker.com. I highly encourage you to use this for free as an initial teaser benefit. So the projected government CPI inflation rate is 3.3%. So 3.3% multiplied by the loan balance, right? The loan balance is 260,000 equal equals right here, $8,580 for the year. So you're getting a economic benefit with the inflation-induced debt destruction divided by 12 months equals 715. So, all right. So everything add into it. All right. So that's the key because the the nominal, we even describe the 5.5% is a nominal rate, as you can see right here, right? The explanation, nominal versus real interest rate. Nominal is the stated loan interest rate, stated, right, on paper. That's the real. Then the real adjusts for inflation to estimate the inflation adjusted cost of borrowing. So the real rate equal nominal rate minus projected inflation rate, right? So nominal rate 5.5% minus inflation adjusted rate 2.2% equals what? 3.3% inflation. So you know what I mean? So what you're gonna do is you add, how you come up with the 60% for this amazing property. Not only you have very, very high monthly cash flow, but annual cash flow this amount plus your principal reduction at the end of the first year, 3,500 plus, like I said, 8,580 for the IIDD economic benefit. Plus, we projected appreciation rate 5%, yeah, maybe a little bit too high. At the end of the first year, 5% multiplied by $325,000 asset equals $16,250 of first year appreciation on paper. So you add on cash flow, principal reduction, inflation-induced deduction, all these number, and the first year appreciation equals 52,733 divided by what? Divided by your down payment, right? Your which is 74,000 equal, right? 71%. 71% total return on investment with including the inflation-induced debt destruction. But wait, it's not over yet. There's more. I sound like an infomercial. But wait, there's more. What I mean by that, we had not even include the tax benefit, right? How come there's no calculation for tax benefit? No, this software just recently added the tax benefit to give an even higher on paper total ROI at the end of the first year. This is the get, we're getting good at this, aren't we? So I'm going to download the PDF file, okay? To give you some true. So I know, see, the total ROI, there are three layers, right? The first layer is a traditional ROI at the end of the first year, 60%. We already calculated that. The second layer is an additional 11% more because of the inflation-induced debt destruction on this particular property. I already explained that to you, 8550, 8580, right? And then the final layer, which is mind-boggling, return on investment with cost segregation and IIDD, inflation-induced debt deduction, which is 98%. We're talking, I mean, 98% total ROI in the first year, 98%, which is what? What does it mean? It means that all your down payment you pay initially is pretty much offset within the first year. Just go to show you the power of income property. There's so many layers to your profit, right? Because the if you look at the iceberg, right, like only 40% of the iceberg of your property is real. You can see it. They are cash flow and appreciation. You can see the equity growth. You can see the cash flow, but below the iceberg there are tax benefit, uh, paper depreciation, tax write-offs, and then inflation-induced debt deduction and principal pay down because the tenant is paying down all the debt, all the expenses for you every single day. The tenant is making you rich, and you have the power of leverage, right? You only put in 20% to 25% down payment typically, right? So you borrow money, you borrowing good debt to your fixed rate debt, right? So you see what I'm getting at? So how am I able to get all my money back? I mean, does it mean on paper you're buying this property for free? You buying this high cash flow, high earning investment for basically for free? Well, according to my calculation, right? I mean, you can technically answer by saying yes, it is a free property. Okay, so why are you guys are sitting out there? If you do not buy this or any kind of property in a way that I explained that to you, the $74,000 you would have put to finance this property, this $74,000 sit in your equity position in your primary home, not earning any return, right? It's a debt equity, or your $74,000 of cash sitting in your savings account or money market account, earning 1 to 2%. Yeah, and it's being eaten away by inflation. The inflation is at least 3.5% according to the government calculation, but in reality, the inflation is a lot higher than 3%. If I look at the cost of groceries or food or whatever, right, and your everyday living expenses, see how inflation and how cost of living have increased dramatically from year over year if especially in the first few years. So how do I calculate 98% cost segregation? Okay, right. I mean, look, cost segregation, that's additional, let's see how much. The cost segregation savings is 19,500 in this particular property. Okay, for the year, this is tax savings though. So that's part of your calculation to determine total ROI. So you divide it by 12 months, so your monthly potential cost tax savings at $1,625. Look, I know it's very, very hard to calculate tax benefit. What do I mean by cost segregation? Normally, your when you buy a property, you got depreciation write-off over spread over 27 and a half years if it is a residential property of 1 to 4 units, right? So you get some little bit of depreciation, phantom paper write-off to offset against your passive income, maybe even your earned income, depending on your situation tax-wise. So, of course, consult your tax advisor. I'm not a licensed tax advisor, but the cost segregation allow and 100% bonus depreciation allow you to do an engineering study and just break down the asset class inside your property. Some asset class is a 5 year write-off, some are 10 years, some are 15-year write-off. So you break down the component of your property. We're going to use 30%. 30% of your property you could accelerate. You could break down to you could lump it into the first year. Okay, accelerated depreciation, first year massive deduction. Okay, you just bring it instead of yeah, 30% of your cost of your structure minus the land value, which is 20%. or the depreciable basis. So some of you are able to get several $1,000s of real tax write-off, depending on how much money you make, depending on whether you doing short-term tax loophole or real estate professional status, all this, the material participation. I'm not going to get into that, but it's very uh, reasonable to assume that this cause segregation engineering study can achieve another, almost 20 grand of paper savings to calculate the total ROI. So this 98%, almost 100% right out in the first year is not unrealistic. Okay, this software, are doing their best to underwrite the numbers as realistically as possible. So at the end of the day, the power. We only talk about the first year. Imagine you could own this property for the next 5, 10, or 15 years. You know what's going to happen to all these numbers? Your rent going to increase, right? And then your loan balance stay the same because it's a fixed rate. But the thing is, the tenant, the rent gonna induce the inflation of the debt. You can reduce your loan balance for the next 5, 10 years. Your loan balance is not going to be the original amount. Can reduce the amount. So increasing value of your property over time, appreciation, right, steady on a historical basis. Go this way like a K shape, the value of your property go steadily go higher. There are some years, there's no appreciation. We all get that, right? Uh, and then the loan balance continue to decrease like a K shape. So the loan to value uh, increase over time because the loan balance get paid down and your value goes up, then you have the ability to refinance your property if you want to, tax-free refinance at the fifth or sixth year from today. That you can refinance. You can buy more property by using the leverage. You see the power of leverage, the power of compounding over time. And then if your rent continue to increase, this rent you're collecting on this co-living property, $1,000 per month, it's going to increase, right? The next few years, your tenant, your workforce tenant, we can gonna pay you more than $1,000 per month, right? That's inevitable. It's gonna happen. So anyway, I think I explain enough. The pure power of buying a rental property. If you buy a co-living property, that's even better for the reason I just show you because of high cash flow, it's high everything, right? So anyway, so that's all I have to say. Again, even though I'm using a co-living property as an example, you could make the argument that I can use any kind of rental property to use this kind of calculation, right? Using this particular unique software, which you can get propertytracker.com. You could download this software for free initially, right? As a to do it, but eventually, you may want to pay the monthly subscription like I do. I pay my monthly subscription because I do so much analyzing using this software. Of course, there are other software out there, but the thing I just share with you, right? This metrics you don't get anywhere else. So that's the value, right? I've been doing this for so long, right? 20 something years consulting with hundreds of real estate investors to buy turnkey cash flow properties, mostly traditional long-term rental in the hot markets, path of growth, new construction, turnkey, with all these benefits. But now we are easily venturing into co-living, which is an amazing asset class. You can accelerate your retirement. This property I just use an example is only a single family home, 325K. We have 7 bedroom, 7 bath, right? We have other investment model. We have duplex, and we have other markets of new construction, co-living properties. That's the whole 9 yards. All right. So it's just amazing. It's a beautiful time to use co-living as part of your investment portfolio. So I'm hopefully you have received a lot of 30 minutes ago when you first watched this video, you have no clue what am I talking about, what kind of numerical analysis. So now Now, hopefully, you are more confident. You learn a lot more real quickly. Uh, the way you calculate investment property, no one have ever taught you this before. Whether you're a rookie investor, whether you're a savvy investor, I know for a fact this is a unique way of calculating. This is the correct way, right? It's the powerful way. Income property is the most lucrative asset class in the world, right? Nothing come close to it, right? So hopefully you got a lot of value out of this video presentation, and just and yeah, and of course like and subscribe to my YouTube channel, and also put your email into my website below into my database, so you can become a free member of our real estate investing community of several thousand members. You can learn every week. We provide you with free contents, so you can continue to educate yourself and get informed, so you can become a better investor. Better yet, if you're really highly motivated, if you like the co-living property or any kind of property we have within our network, please contact me directly. If you're motivated, you think you can qualify, you can pull the trigger fairly quickly after doing some additional due diligence and what have you. Then I'll be more than happy to initially do a consultation over the phone, FaceTime, or even Zoom video, so I can understand, hear about your goals and objectives, or your strategy, or in alignment with the kind of process and the system and investment model that we use. If there's a if there's a alignment, if there's a chemistry involved, then we can work together. We can help you, myself and my team, on the ground in different markets, to can help you to invest for the long term. Thank you so much for attending. This is SeeWing Yee. I'll see you next video. Have a nice day. Bye bye.